What we tried to do here was to revisit the investment case for the tier 2 banks, largely on the back of the changed structure of the banking industry. What's happened now is the tier 2 banks now control much lower market share. They control just 20% of assets compared to 38% in FY10. Now, the biggest implication of this is that they now have much lower resources to pursue cheap deposits compared to the tier 1 banks. And the conclusion of this was that the deposit structure of the tier 2 banks will be a key earnings differentiator for them. And of these banks, the biggest winners, or should I say the early winners on this front, are Diamond Bank and Fidelity.
Okay, we'll come back to the discussion, investment case for those two in particular, but some issues that you're highlighting include capital. That's something that could restrict the growth of these banks, especially if they're looking at M&A.
Yeah. Well, I think one thing is clear. Diamond Bank is obviously the most undercapitalized of these banks. And as a half year, their reported capital adequacy ratio was 12%. If you capitalize their half year PAT, that increases to 15%. Okay, so what they're planning to do is to continue to raise tier 2 capital.
But maybe it's important to clarify why that is key, because the minimum capital requirement is 10%.
It's actually now 15%.
It's now 15%.
It's now 15%. CBN increased 15% about 2 months ago.
Oh, I see. Okay.
So Diamond Bank will be raising additional tier 2 capital. What we've included in our models is an additional $100 million to come through. $100 million came in the first half, and we expect them to capitalize 80% of their profits for this year. So essentially, we're modeling for much lower dividend payout ratios going forward, and this is the plan for that the bank has. So so they expect to raise additional tier 2, and we think by the end of the year they should be on at least 16% capital adequacy ratio. Skybank too has capital issues. They've raised $100 million tier 2 this year. They've also raised $150 million in pure debt.
Okay, let's touch the issue of cost, and maybe starting from interest cost, because net interest margins is something that is very key for a lender. Talk us through the dynamics for that, because we know that the larger banks, the tier 1 banks, have a huge pool, most of them anyway, have a huge pool of cheap deposits.
So for the tier 2 banks, like I said initially, deposit structure will be key going forward. So what we're looking at here is the tier 2 banks. There's a recurring theme in the industry now. These tier 2 banks are moving into the top end of the market, while some tier 1 banks are unwilling to compete on price and are beginning to look at, beginning to move down the risk ladder. So the risk the tier 2 banks face is that their NIMs get squeezed. So as they raise more tier 2 capital, lend this out in dollars, the spreads are thinner. This will impact their NIMs negatively. The other key thing is some of these banks are also still heavily reliant on term deposits, Skybank in particular, 47% term deposits in Q1. So if you have a lending strategy to up-tier and they're relying on expensive term deposits, your NIMs will get squeezed. And we already saw this in Skybank as a half year. Right. NIMs moved from 6% in Q1, collapsed 80 basis points to 5.2% as a half year. So this is the risk these banks face. But we think of these banks, Diamond Bank's NIMs also likely to get squeezed, but nonetheless, the NIMs will remain the best in class among the tier 2 banks.
Okay, let's talk more strategy here. We know many of the banks are focused on retail banking in particular, but that's something that even the larger banks are now looking to be major players in. What's the implication of this for the tier 2 banks in particular?
The tier 2 banks are moving out of retail and mid-corporates because they got their hands burnt following the banking crisis. So moving up the risk ladder is really their focus now. So it's not retail. The biggest bank which will remain in retail, or should I say retail remain a key story, is Diamond Bank. This has been a key differentiator in their deposit structure. Of the tier 2 banks, they have the most attractive, should I say, deposit structure, just about 23% in term deposits. The next bank in close ranking is Fidelity, about 29%. FCMB, we think they should emerge into this nice structure following the acquisition of FinBank, but they still have a lot of issues to deal with following the M&A. Skybank is the one that really needs to get the funding structure right. It's just not, we don't think the funding structure is right to support the lending strategy they're pursuing.
And let's close on your rating of Fidelity and Diamond Bank. These are the banks that clearly you like most in that space. Talk us through the investment case for those two. Okay,
what we've done is we've upgraded Fidelity to a buy from hold. Diamond Bank was buy previously, but we've updated our forecast. PAT for this year is now 112% higher. For Fidelity Bank, the key thing here is a valuation play. Straight 0.3 times book, potential dividend yield of 28%. That's attractive. There are issues with the business, but given all the discounts in the price, we think, it's worth looking at. For Diamond Bank, it's a nice business. We like deposit structure. Capital issues are being sorted out. It's key. Asset quality issues need to be sorted out as well. This is caught in its investment case as well. But it's also trading at 0.3 times book. It's less attractive from a dividend perspective, but it's also the bank that gives you the most significant divergence from its history on the ROE front. We think ROE is going forward to be, on average, at least 20%.